Hello all. All of us are awaiting the first full-fledged budget of Modi version 2.0 to be presented by the Finance Minister on February 1st. What is this budget? What does it contain? And why is it important to you? Please allow me to explain briefly. Now, just like a company's balance sheet, the union budget is a government's balance sheet. It contains the estimates of income, expenditure, usually for a set period of time. So basically what it means is what is coming in, how much is going out, or how much is being spent, and also where the money is being spent. That is what a union budget details. Now, the Ministry of Finance prepares the budget in consultation with the various stakeholders of the economy, namely the other ministries, the state governments, private industry professionals, the industry experts, etc. Now, the union budget can be classified into three: capital budget, revenue budget, and expenditure budget. Capital budget gives details on the government's capital payments and the receipts. The receipts can include loans from the public, loans from RBI, while the capital payments include the expenses on the long-term assets and facilities of the government. For example, spending on health, educational facilities, buying and maintaining equipment, etc. The revenue and the expenditure budget details all the other revenues, the receipts and the expenditure of the government. Now, if the expense is more than the revenue, then it is supposed to be a revenue deficit budget. Now, why is this budget important? For any elected government, the priority should be on a balanced, inclusive economic growth for the country. Now, the union budget provides a roadmap on how the government intends to tackle this challenge of an inclusive economic growth and also giving importance to social equality. So, since it is a roadmap, it is important for all the citizens. It can impact all the citizens of the economy, how this budget, how the proposals and the measures included in the budget work out. It could be with regards to the allocation of the resources effectively to increase public welfare. It could be fair distribution of income through subsidies or taxes. It could also be providing adequate job opportunities and also lifting the downtrodden section of the society. Especially considering that India is a demographically young country, the government should make adequate provisions in the budget to ensure that there is inclusive growth in the country. Depending on the economic situation, the budget provisions also, it could be a surplus budget or it could be a deficit budget depending on the economic growth of the country. For an individual, the budget could give pointers on the various new services and facilities offered by the government, income tax rates, the personal tax rates, the taxes on the services that are being used. For a corporate, it could give pointers on the business strategy that the corporate needs to adopt, because the budget will give indications on where the government is focusing, where the government intends to spend the money on various sectors. The budget this time has unusually high relevance in the sense of the slowing economic growth of the country. GDP growth rate came in at 4.5%. So the stakeholders are all looking up to the government to include measures in the budget that can revive the flagging economy, that can boost the demand in the economy. For individual taxpayers, they are more looking at increasing their cash in hand. So any cut in the income tax rates will definitely boost their sentiments. For corporates and for the stock markets especially, we are looking for definitive measures that can boost the economic growth rate in the country. We've seen recently the government announcing the huge 102 lakh crores in infra spending target. The budget, the balance sheet will provide details on how the government intends to raise this capital. So, as a whole, I hope you have enjoyed this short video on the union budget, on what it contains and its importance. Thank you very much for your time. Thank you.